Hello, everybody, and welcome to this week's podcast for the week of March 12th. We're recording here on March 11th. I'm joined here by good friend and colleague David Clark. How you doing, David?
I'm good. It's nice to feel some spring weather here in Richmond for sure. I even think we actually got up into the 80s at points, and it's may get near mid 80s today.
I
It's
know I went on a run this morning for maybe the
yeah.
first time in a handful of years,
You just
and
talking about it run makes me tired.
I was tired after about 5 steps. And I was with one of my buddies out here in Scotts around the office, and we got past a mile, and I was like, dude, we gotta stop. But yeah, talk about relatively weaker. I felt relatively weaker today than I did a couple of years ago when I started. Look at that transition over into the relative strength side of things. But we've seen a lot of a lot of relative changes over the last week. Domestic equities have rolled over, have rebounded a little bit here with it looks like maybe some of the conflict in the Middle East is coming to an end is kind of what the
Perceived,
Trump
yeah.
had said.
Yeah.
But we'll see, that could change tomorrow, quite literally. But you've seen obviously a lot of action around areas affected by that group, by that part of the globe. Aerospace and defense names have done particularly well. Crude oil, which we'll talk about, has pushed commodities higher. So a lot of relative action. David and I are going to look through a couple different charts today. Which one do you want to start with?
Well, I mean, we might as well start off with the conversation around commodities
Sure.
specifically. And you were leading into a relative strength sort of foray, if you will. But the big piece that we saw in terms of relative strength movement was commodities moving up into second, overtaking domestic equities for that second position within our Nasdaq Dorsey Wright asset class rankings, Dolly asset class rankings. So, not insignificant to see that. Now, bear in mind, I think we've even talked about this in the report some this week. We saw similar action last year when the
Yep.
three asset classes kind of jockeyed for position. They each took a turn in first place. That was sort of through May, April, May on into early June.
Yep.
And then things separated back out with domestic equities coming back to the top. So not all too far kind of context to for us to look back to in terms of how we can sort of see some of these signals move around, especially when we still see a very risk on tilt to Dolly.
It's a very good point that you make. I mean, commodities are in second, followed by domestic equities now in third. International equities are in first. We've been talking about international dominance for the better part of the last year or so. But yeah, like you said, those three groups comparatively to the groups at the bottom of our rankings, fixed income, currencies, cash, those areas are relatively weaker. However, I will note, and each analyst is going to have a slightly different read on this, but I'll say, be cautious when you're making broad asset changes, particularly when it comes to ditching domestic equity exposure in favor of a group that moves around a lot, like
Buying
commodities.
commodities.
Like the point is a lot of that strength that's been spurred on within the commodities group has been focused on crude, which we'll talk about more in just a moment, hitting nearly $120 a barrel, over the weekend before cooling off. And so a lot of that, it's very volatile. The reason for, and the reason why I say that is we'll typically talk about having a process. Dolly is going to utilize, even if there's a one signal change between the groups in leadership, it's going to change its rankings up. We'll typically say wait for 5 or 10 signals worth of difference between groups before you actually go and kind of consider that a confirmed shift, if you will. Am I saying that right, David? Do you have any other
Correct.
thoughts?
And even to your point, we technically haven't even hit that five signal threshold just yet.
Right.
So commodities is only ahead of domestic equities by four, but back to your point of you're not likely making an enormous allocation shift based off of this. In essence, you're getting confirmation that commodities is still very much part of an allocation. I
Right.
mean, it's been that way for really a couple of years now, where it's part of the conversation. It's not leading the conversation. We haven't seen that happen since really 2022. But it's in there. It's along with international equities and domestic. So you may have seen your portfolio grow to the point where that commodity position is a little bit bigger, but that's okay. Just kind of leaving that tight. You don't need to really make any type of massive increase into exposure. None of our strategies have. I
Right.
mean, that's key to note that really most of them are still very much overweight or almost tilted towards domestic or international equities, depending on what you're looking at.
And probably a happy medium for those of you because, commodities can be difficult to get exposure to, right? You got
Hmm.
K1s that are just a mess come tax season for a lot of us. What that might look like in a practical sense for you all is you're not necessarily shifting away from domestic equities, but you will go and say, where are some energy focused stocks? Where are some energy focused ETFs that way, again, sure, we can kind of get exposure to the energy group that way, or we can go say, where are gold miners or something like that, right? Take that as confirmation of we don't necessarily need to get out of domestic equities, but it is confirmation that commodities and those types of stocks, those types of funds are, like you mentioned before, still players in the portfolio. Does that make
Hmm.
sense?
They are, they are. Well, and especially the energy space has, whether either equity sectors or commodities, has
Yep.
gotten a massive boost this past week and really over the weekend from a relative standpoint. And that's because, like you said, we saw crude rally just shy of 120, but pulling up a longer term 2 point per box chart, that one column of X's where we saw the rally up to 120 started on a reversal up to 62 back in January.
Yep.
This, at least on this particular 2 point per box chart, probably one of the longest column of X's you're going to see for crude.
Not often on the platform for the listeners, not often we'll during part of our kind of data review, we'll see a bad pull of data and it'll like send the
Mhm.
chart way higher. And this
This
is
is not.
this is not. The point is that it kind of reminds me of one of those where it's like you got
You're
all
like,
the way
something
up
looks a little fishy
and then the
here.
very next day you retrace, which is literally what
What
happened on the
happened?
chart. Because we opened much higher and then rallied up into the close. That was when the kind of news was, hey, I think we're close to done here. Um, Again, that was just the cited news. But point being, that was what saw crude fall the next day, get a big back retracement down to the top of the trading band,
Yeah,
right?
you initially saw it come down to 90, but then even yesterday's action really went ahead and brought it all the way down to that $80 range, which is still overbought,
Right.
interestingly enough. I think it was earlier this week, whenever, or after Monday's close, I believe, whenever we really saw that initial kind of pop and then retracement in the afternoon. Um, it the overbought oversold weekly overbought oversold rating was north of 200%, which
Right.
is the first time looking back at all that history going to 1983 that you could spot it.
Right.
We
Back
had a
up there.
few,
Yeah.
even in COVID, it was north of 100%, but not 200%.
Right.
Provides some context in terms of the historic level of overbought that it got, and to see this type of quick retracement, it's almost like we've talked about the rubber band conversation. If it stretches too far, eventually it either breaks or it snaps back,
Right. Yeah. Oh
Yeah,
yeah.
so,
Well,
and
and
this was the snapback for sure.
right. And it comes to a very logical point. I mean, even with I said that the chart looks funny, right? It comes to a very logical point where you're pulling back to this big range of old resistance. If you look at the chart,
Mhm.
we've really been grinding lower for the better part of the last couple of years. This area, in the where is that? The upper 90s, upper 80s, or where are we? Are we at 60? What is that? Wait.
Lower 80s,
Yeah,
I
lower.
believe.
There it is. I'm all discombobulated with the chart. But you've got a lot of old resistance playing in there
Mhm.
that, if we were in place for a more tailwind for energy, you figure that crude would set up a base camp around that old resistance.
Right. And
Yeah.
really, I think that's moving forward what we're kind of keeping an eye on. Does it do that? Kind of set up the new level of support if we continue to see it rally, new level of support around this prior resistance. I think if it moves back below that resistance and dives back into the 60s, then you've really kind of seen a pretty notable change in tune.
Right. Well, and
Um,
this is the biggest supply and demand game. We always talk about stocks and individual names playing supply and demand. This is literally a supply and demand
right.
relationship, right?
Yeah.
So as long as there's headlines, as long as there's unrest in the Middle East, we're
Especially threatening to interrupt supply
right.
for
Exactly.
sure.
So that just keep that in mind. I mean, obviously we're going to focus mainly on the technicals, but we're not naive. There's a lot of stuff that's affecting this from a headlines perspective. We're going to try to look through as much of that as possible, but there's only so much you can do in some cases.
Yeah, I mean, because ultimately, when for us, in many cases, it's coming down, well, how's price responding?
Right,
You
exactly.
know, you can read as many headlines as you want, but ultimately, the question ends up, how is price responding? How is that affecting my possible buy, sell, or hold decision?
Right.
That's really it. Yeah.
Talk about buy, hold, and sell decision. Lots of question marks on the domestic front and where strength has come from. A lot of it is on the energy front, but some of where strength or weakness has emerged, I think, is probably the other point. So to evidence that, most of us are going to be familiar with the Mag 7. I think all of us listening are probably familiar with the Mag 7. You can take a look at that kind of proxy Mag 7 by looking at the fund MAGS. It's a round tail fund, MAGS. And from a technical perspective, really interesting break over the last week or so here. We've seen that break a quadruple bottom, return to a sell signal for the first time this year, and move down towards the bottom of the trading band. So we've seen, I guess in layman's terms there, we've seen weakness, particularly from these big stocks.
Yeah, those darling Magnificent Seven
Yeah,
really that had, in a lot of ways, become fairly dominant in many portfolios through 24, 25, but especially 24. I mean, it seemed like everyone's portfolios
right,
had significant positions in these. And I think in 25, you sort of saw that at least most people continuing with the trend, but beginning to be a little skeptical and lighten up
right.
on it. And kicking off this year, you've seen some of those trends, especially on the subsector front, particularly software related, really have an impact on this group,
Right.
and I think at this point, it's sold off to a pretty significant level, but we're also not really to the level that you would say it's really super oversold or extremely oversold or even washed out yet
Right.
either. So I mean, there's still an air of caution here that you're sort of keeping a close eye on. It's definitely a yellow light.
Right. Well, and the fun score, talking about the fun score system ranging from 0 to 6, with 3 being acceptable, the fun score shows that. We've got a 3.63 fun score here. You know, am I going to go get rid of it over a 3.63 fun score? No.
No,
Am I going to go add to it?
no.
No, right? Like it's one of those ones where I'm probably just let's sit tight with exposure. If
Hmm.
we need cash, if we're over allocated, sure. If you're still over allocated after this decline, trim a little bit, right? If you're under allocated because you ended off last year and you had cut a bunch of exposure, sure, you can add a little bit here or there, whatever it might be. But I think the moral of the story on this case is we're not making a definitive we need to go all in or all out at this point, right?
Right. Yeah. Because I mean, have you seen the breakdown? Yes, but has it significantly shown that long-term relative strength picture completely deteriorated yet, or that trending picture deteriorate yet? Not quite.
Yeah,
You know.
be careful. I mean, this is one where you're just keeping a leash or a tighter leash on the position.
Yeah.
And this goes for all of them. We're looking at an ETF representative here, right? But this goes for all of the representatives within there. You can
Hmm.
make individual support and resistance calls about each one of them. They've all got very interesting stories to tell on their chart. But just kind of as a broad group, we have seen deterioration, but it's not necessarily something that we're ditching the group for. I think is the moral of that chart.
Yeah, from that prop perspective, but there has been pretty notable moves along with a variety of things, but indicators
Right.
have also seen a shift downwards with domestic equities moving at least lower, generally speaking, over this weak roll that we find ourselves in. Um, Now, the notable one that we saw roll over last week was the bullish percent for the NYSE. It reversed down early last week, but even this week's action kind of kicking off with it dropping below that 50% mark, down around into the mid 40 range, I think technically 46% on its chart. So at least seeing a notable development in the fact that we're watching bullish percents, especially this one, drop below 50%. That 50% demarcation line is a little more important for long-term indicators like the positive trend, but still significant in the fact that now we know less than half of the stocks of the roughly 1,800 on the NYSE are trading on are still maintaining point and figure buy signals. The majority are on sell signals at the moment.
It's a good point, but I will mention this to you just as a counter,
Hmm.
right? And I'm curious your thoughts on it. We're not washed out here, right? For all of the fear, I feel like, that people have said, oh, we're overbought, or the AI bubble, or which has
Mhm.
dissipated a little bit with this recent sell-off. But there's been a lot of volatility, right? With that said, though, the indicators, even the more near-term indicators that really are
Exactly.
look at some of your
Like the 10
10 weeks,
weeks,
right?
weekly
They aren't
distributions.
really oversold yet, right? They're not really washed out, which maybe is a bull and bear case, which is bull case. We have seen volatility, but the average stock has held up pretty well.
Mhm.
That's a bull case. Bear case is we've seen a lot of volatility and we're not washed out, right? There's still a lot of room to the downside that we could take this. I don't know which camp I'm in. I typically tend to lean a little bit more bullish, so maybe the former in my mind. But I'm curious your thoughts on that whole paradigm, maybe.
Well, I mean, I think at this point you're probably still leaning mostly bullish
Right,
for things. It's not really gotten to the point where, you've not seen domestic equities totally fall behind and die. You've not seen groups and asset class group scores really significantly fall below three.
right.
You've started to see some initial rumblings of, all right, well, this has been pretty bumpy.
Yeah, 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 yeah.
Like, we've definitely had our bumps in the road for sure. But to your point, we've still not gotten to a level with many of the indicators that have considered to be washed out or low levels yet.
Right.
And barring what we've seen at least from end of last week, beginning of this week, roughly kind of a 2 day span, you've seen things kind of mellow out, at least it kind of sense. So it'll be obviously there's a multitude of potential catalysts, but I think sort of the recent catalyst, there at least to be seeing some layer of it's dying down now.
Right.
So I think, like I said, that still gives us that bullish tilt,
Right.
and puts us in that camp. And I mean, to your point, another reason I think it still gives us that bullish tilt is when we look at something longer term like the PTNYSE. It reversed down over this earlier this week, but still maintains above that 50% mark.
Hmm.
And above a low point that we saw, that 50% mark being in November of last year, too. So again, there's still a tilt to me to the bullish side, generally speaking, but I think we are starting to, at least in now, seeing some of the indicators come down to levels where we're going to very closely monitor them for their next potential leg down, because that might be sort of the significant level that it's like, okay, we're maybe looking like we might visit washed out territory and then get a rebound.
Right. That's very fair. The other thing I'll mention, and then we can jump on to the last chart, is the reason that participation has stayed relatively elevated, but performance or things have felt a little bit more choppy, is because if you go back to that MAGS chart, we don't have to throw it up on screen or anything, but point is, if you go back to the Magnificent Seven, those guys are the ones that have fallen the most, right? Or
Mhm.
relatively, right? We've seen relative weakness from those guys. While the average S&P 500 stock is still what I think they're still positive this year. I don't quote me on that, but at least I think they're still positive if you look at RSP versus SP, SPY, right? RSP is still doing relatively better. And so you're still seeing the majority of stocks do relatively well, but it just feels worse because the big guys are lagging
Well, and
behind.
where most people's portfolios have been,
Exactly.
or
Yeah.
where
Yeah. Yeah.
we're
Yeah.
getting the brunt of. And I think you've seen some of our strategies adjust to that already,
Right.
especially sector rotation strategies
Right.
have
Out of
made
tech.
that
Yeah.
adjustment, shifting out of tech, going elsewhere. A lot of materials, energy, even in some cases, biotech
A
exposure.
lot of industrials.
Yeah, a
Yeah.
lot of industrials exposure, but you've seen that shift out of tech.
Yep.
But at this point, so many people's portfolios over the past 2 years were so significantly in some of those individual stocks or even in tech related funds, whether it be thematic or some other form, that it's just felt that bad,
Yeah.
you know. And I mean, it's forced you, at least if you've been following hard research, it's probably forced you to go ahead and make some type of changes and shifts away from that. But in not raw following our research, just simply the fact that you probably had a terrible experience to kick off the year has probably caused you to make things think about making shifts or make shifts anyways. So
Well, to talk about terrible experiences to start off the year, let's go ahead and look up our last chart, which is the chart of Bitcoin. I was waiting. I was like, where
Where
could I
can I segue
transition
this?
over on there? I mean, Bitcoin and just crypto in general has been a real laggard. I mean, you're down, what is that, 20,
20%.
25% this year so far, returning to a sell signal on its what is this? This is the default chart
Yeah.
here. Returning to a sell signal after cresting up there over 100, 110,000 coin or so, kind of backing off. Very interesting. We've seen a lot of relative weakness from this space. We've seen it, return to sell signals against cash, so like failing its bogey check, if you will. But in general, this is a place that has really been hit hard. And I know a lot of you, if you are listening and you love crypto, there's probably nothing that we can say to get you to lighten up crypto exposure, right? For anyone who likes it. But point is, we're seeing a lot of weakness in this space.
Yeah, and I mean it's similar conversations to when you're talking about potentially with commodities exposure, as there's so much volatility there at play. That, I mean, you almost have to tamper expectations for exactly what you're looking to get out of that
Right,
particular part of the allocation. So because we know as quick as this can deteriorate, it also can accelerate back too. So I mean,
right.
it's crypto is definitely a challenging one. I do think a little bit of a near-term silver lining is the fact that we've seen that default chart at least reverse up off those lows. Now we're starting to see at least tick back down a little bit. But long term, you've got some support there in that kind of 60 to upper 49,000 range. So at least giving you some idea of potential level of where it's settled out here, where you've had some buyers step in at least.
Yeah, I mean, I'm looking at the chart. You're looking at there's a couple different crypto. There's a winter in 22 was that, but looking at 2024, 2025. Interestingly enough, each time after you got a pair of sell signals, you broke higher. That's just an interesting observation there. Obviously, we're on one sell signal at this point. If we get a reversal lower. Not saying that I'm bullish at that point,
Yep.
right? But kind of recent history says is that we see supply take over and then there's rapid uptick in demand.
That second sell signal, if we were to, hypothetically see that, brings us down to that 50,000, sort of mid 50,000 support
Right, where
level.
there's
So
support. Yeah.
it's a potentially interesting setup for sure.
We'll see.
But
I don't know if I'll be
we'll
buying it down
see.
there, but
Yeah.
for more, always obviously, check in on the podcast. The other thing which we'll mention for you listeners is we have opened up registration for a handful of events. There obviously is the big one that we talk about each year out in Nashville. We're doing that again, year 3 out in Nashville. It's a hell of a good time. Registration's opened up for that. It's on the platform. And then there's also two smaller regional events we've got going on. One up in we're calling this the Shakeout, not a conference, but event, I suppose. And that one's up in Philly to start off next April. And then we have another one in Charlotte, and that is
March 26th.
March 26th. So actually, coming up. So point is, if you're in either one of those areas, I'd love to have you all there. Registration for those is on the platform, or you can just shoot us an email and we'll direct you at NDW support at Nasdaq.com, I believe it is. Don't quote me on it. But point is, we'd love to see you there. Appreciate you all listening. David, take it away if you got any other thoughts.
Always good to be back on. That's all I gotta say.
Perfect. Appreciate it, y'all, and have a good one.